In April 2020, the chief executives of the four largest U.S. airlines sat across from the U.S. Treasury and asked for help. Combined, the industry received over $50 billion in federal payroll support and loans to survive a pandemic that had grounded the fleet. Footnote 1. That's the headline everyone remembers. Here's the part that didn't make the press conference. In the 6 years before that ask, those same four airlines had spent roughly $45 billion, north of 90% of their free cash flow, buying back their own stock. Footnote 2. Not investing it. Not saving it. Spending it deliberately to shrink the number of shares outstanding and push the stock price up. Then, the first time real turbulence hit, the same companies that had spent nearly a decade optimizing for shareholder returns turned to the public for a bailout, because there wasn't enough cash left in the building to survive a bad quarter, let alone a bad year. This isn't a story about the airlines being unusually reckless. It's a story about them doing, with unusual visibility, exactly what the rest of corporate America does every single year, almost $1 trillion worth of it. Footnote 3. This is the buyback economy. And it starts with a rule change from 1982 that almost nobody has ever heard of. So, here is what a share buyback technically, mechanically is. A company takes its own cash and uses it to purchase its own stock on the open market, then retires those shares, permanently removing them from circulation. Footnote 4. That's it. That's the entire mechanism. No product gets built. No factory gets opened. No employee gets hired. The company simply becomes owner of a smaller slice of itself, cash for shares, and the shares that remain outstanding represent a slightly larger claim on whatever the company earns going forward. Here's what that mechanism does to the numbers, and why it matters more than the plain description suggests. Earnings per share, EPS, the single number Wall Street watches most closely every quarter, is net income divided by the number of shares outstanding. Shrink the denominator, and EPS goes up even if net income, the actual profitability of the business, doesn't move at all. Footnote 4. A company can report the exact same earnings 2 years in a row, buy back stock in between, and show growth on the metric analysts care about most, without producing a single additional dollar of profit. This is legally and functionally distinct from the other way companies return cash to shareholders. The dividend. A dividend puts cash directly into a shareholder's account, taxed as income, available to everyone who holds a share equally. A buyback does something quieter. It changes the ownership math for whoever doesn't sell into it, and it hands whoever times the sale correctly a tax-advantaged capital gain instead of an income tax dividend. Footnote 5. For decades, this asymmetry mattered more than you'd think because for most of the 20th century buybacks of any real size were something companies mostly avoided. Here's why. Before 1982, a company aggressively buying back its own stock ran a real legal risk of being accused of stock price manipulation under federal securities law. The Securities and Exchange Commission had no formal safe harbor, no clearly defined do this and you won't get investigated rule for open market repurchases, and manipulating your own share price to benefit insiders is, in fact, exactly what a market manipulation statute is supposed to prevent. So companies that wanted to return cash mostly paid dividends, and buybacks stayed a comparatively rare, cautious tool. Then, in November 1982, the SEC adopted Rule 10b-18, a safe harbor provision that gave companies a specific set of conditions under which a buyback would be presumed not to be manipulation, even though the underlying activity, a company moving its own stock price by purchasing its own shares, hadn't changed at all. Footnote 6. The behavior didn't become safer. The legal treatment of the behavior did. The specific conditions worth knowing because they come up again later. A company can buy back up to 25% of a stock's average daily trading volume through a single broker, avoiding the opening and closing minutes of the trading session. Stay inside those lines and the SEC treats the purchase as routine. Step outside them and, at least in theory, you're back in manipulation territory. In practice, staying inside the lines is not difficult, and virtually every large buyback program does. The number that tells you what that legal change actually unlocked. In the years immediately after Rule 10b-18 took effect, buyback volume roughly tripled. Footnote 7. Not because companies had suddenly found more excess cash lying around. Because the rule that had been discouraging them from spending it this way was gone. 40-plus years later, that once narrow safe harbor is the primary channel through which corporate America returns cash to shareholders, outpacing dividends most years, and the SEC's own rule, largely unchanged in its core structure since 1982, still governs nearly all of it. Footnote 6. Section 2 is where the scale of what that unlocked actually gets counted. So here's the scale 4 decades after the rule that made it routine. S&P Dow Jones Indices, the people who track this with more precision than anyone else, because they compile it from actual corporate filings every quarter, recorded roughly $942.5 billion in buybacks among S&P 500 companies in 2024 alone. Footnote 3. Call it just under $1 trillion in a single year from 500 companies spent buying pieces of themselves. Go back to the airlines from the cold open, because the contrast is the entire argument of this episode in miniature. Between 2014 and 2020, the 4 largest U.S. carriers, Delta, American, United, and Southwest, spent a combined $45 billion on stock buybacks, representing more than 96% of their free cash flow over that period. Footnote 2. 96%. Not 40. Not 60. Nearly all of it. Meanwhile, industry reserve cash, the buffer that exists specifically to survive a bad year, stayed thin enough that when a genuinely bad year arrived, in the form of a pandemic that grounded commercial aviation almost overnight, the industry needed federal intervention within weeks. Footnote 1. The same executives who had spent 6 years telling shareholders that returning cash was the responsible move spent the 7th year telling Congress that the company couldn't survive without a bailout. Zoom out from aviation, and the pattern holds at the broader economy level too, even if it's less dramatic when there isn't a pandemic to expose it. Research tracing buyback activity across large public companies has found that firms engaging in the heaviest buyback spending, as a share of their cash flow, tend to show measurably weaker capital investment and R&D spending relative to firms that return less cash to shareholders this way. Footnote 8. That's not a claim that buybacks cause underinvestment in every case. Plenty of companies buy back stock responsibly, out of genuinely excess cash, without shortchanging anything. It's a claim about where the money goes when it's not going somewhere else, and the airlines are simply the case where, somewhere else, turned out to matter within a single business cycle instead of a slow multi-decade drift. Here's the human-scale version of the trillion-dollar number, because the abstraction is easy to lose. $942 billion is, for comparison, larger than the entire annual gross domestic product of countries like the Netherlands or Saudi Arabia. Footnote 9. That's not spent on new products, new hires, new plants, or new research in a single year. It's spent shrinking the pool of people who get to own a claim on next year's profits. Compare that trillion-dollar buyback total to a completely different number from the same economy, in the same period. Real median wage growth for American workers, adjusted for inflation, has moved by low single digits year over year. Footnote 10. The same corporations spending record sums buying back their own shares were, on average, not spending anything close to that scale raising the pay of the people producing the earnings being bought back against. And the trend line, worth noting before this episode moves to why nothing changes. Buyback volume has grown almost every year since Rule 10b-18 took effect, with brief dips during recessions and a sharp temporary pause in 2020, the same year the airlines needed rescuing, before resuming its climb the following year. Footnote 3. The rule from 1982 didn't just open a door once. It left it open permanently, and corporate America has been walking through it in larger numbers pretty much every year since. None of this happens by accident, and none of it happens without someone specifically deciding, every quarter, that this is the best use of the company's cash. Section 3 is about why that decision keeps getting made the same way year after year, regardless of who's sitting in the corner office. Some reasons why it stays this way. So if the pattern is this visible, and the airline case makes the risk this obvious, why hasn't anything changed? There are roughly 4 doors. Door 1. Ban buybacks outright the way they were effectively discouraged before 1982. It's been proposed repeatedly, including in federal legislation. It runs into an immediate practical problem. Companies that want to return cash without the tax profile of a dividend would likely just find another mechanism to accomplish something close to the same thing, and an outright ban does nothing to address the underlying incentive, the fact that executives are paid overwhelmingly based on metrics buybacks are specifically good at inflating. Footnote 11. Companies have already demonstrated the workaround appetite exists. Accelerated share repurchase agreements, tender offers, and other adjacent mechanics could absorb at least part of the redirected cash if the open market version were banned outright. Door 2. Tax the behavior instead of banning it. This one actually happened. The Inflation Reduction Act of 2022 imposed a 1% excise tax on net stock buybacks, effective 2023. Footnote 12. 1%. On an activity that, done well, can boost a stock's earnings per share figure by several percentage points in a single year. The tax exists. It shows up as a minor cost of doing business, not a deterrent, because the benefit to the people making the decision vastly outweighs a 1-point tax on the transaction. Door 3. Force more disclosure so at least the public and regulators can see the pattern in real time instead of piecing it together after a crisis. The SEC actually tried this too. New rules adopted in December 2022 would have required far more detailed, timely disclosure of buyback activity instead of the current quarterly reporting. A federal appeals court vacated the rule in October 2023 on procedural grounds, before it ever took full effect, and the SEC has not successfully replaced it since. Footnote 13. The door opened. It got shut again on a technicality before anyone walked through it. Door 4. Let the shareholders themselves push back, since buyback authorizations require a board vote and indirectly shareholder acquiescence. Here's where this episode connects directly to the one before it. The same concentrated voting power this show spent an entire episode explaining, the roughly 1 in 4 votes cast at S&P 500 annual meetings by 3 asset managers, is the voting power that approves, or at minimum does not meaningfully object to, the buyback programs described in Section 2 year after year. Passive funds are structurally disinclined to vote against management on capital allocation unless something has gone dramatically wrong, because their entire business model is holding the whole market cheaply, not picking fights with individual boards. Footnote 14. Every door has a locked room behind it, and this one doesn't need picking. The people holding the key already voted to leave the door open. Executives are paid overwhelmingly in equity tied to the stock price a buyback is specifically designed to lift. Footnote 15. The shareholders large enough to object have a structural disincentive to bother. And the tax and disclosure reforms strong enough to actually change the calculation keep arriving either too small to matter or too fragile to survive a courtroom. Nobody in this chain is doing anything against their own interest. That's precisely the problem. Every structural argument on this show eventually asks the same question. Who decided it should work this way, and did they know what they were doing? The person most responsible for the 1982 rule is John S. Shad, the SEC chairman appointed by Ronald Reagan in 1981, a former Wall Street executive who came to the agency with an explicit mandate to reduce what he considered excessive regulatory friction on corporate America. Rule 10b-18 was one piece of a broader deregulatory push during his tenure, and by most contemporary accounts, it was treated internally as a technical, almost administrative fix. A safe harbor to reduce legal uncertainty, not a deliberate attempt to reshape how corporate America would spend nearly $1 trillion a year 4 decades later. Footnote 6. But the vote wasn't unanimous, and the dissent is worth naming specifically, because it's the kind of documented, on-the-record warning this show looks for whenever one exists. Commissioner John R. Evans voted against the rule's adoption, on the grounds that a defined safe harbor would functionally invite exactly the price-supporting behavior the underlying manipulation statute existed to prevent, that giving companies a clear, bounded set of conditions under which repurchases wouldn't be investigated was, in practice, giving them a map for how to move their own stock price without technically breaking the law. Also footnote 6. That warning is over 40 years old. It is difficult, looking at the scale in Section 2, to call it wrong. The modern indictment comes from an unlikely source, not a politician but an economist, William Lazanick, whose 2014 Harvard Business Review essay, Profits Without Prosperity, gave this entire phenomenon its sharpest name. Lazanick's core argument, using data across hundreds of large public companies, was that the shift from what he called retain and reinvest to downsize and distribute wasn't incidental to declining middle-class income growth. It was a direct, traceable mechanism connecting corporate cash allocation decisions to the stagnation this show discussed all the way back in Episode 1. Footnote 15. Money that would once have funded R&D, wages, or expansion was, increasingly, being redirected specifically toward the metric that determines how much executives personally get paid. The data point of his that got cited most often in the years since, Between 2003 and 2012, 449 companies listed in the S&P 500 devoted over 90% of their combined net income to buybacks and dividends combined, leaving less than a tenth for the reinvestment that, in an earlier era, would have been assumed to come first. That's the piece that closes the loop this episode has been building toward. Buybacks aren't just a capital allocation choice made in a vacuum. They're the mechanism that connects a 1982 deregulatory safe harbor to a 2024 near $1 trillion total to the executive compensation structure that specifically rewards the people approving the buyback for approving the buyback. Also footnote 15. Commissioner Evans warned in 1982 that the rule would let companies move their own stock price on purpose. 42 years later, moving the stock price on purpose isn't an edge case. It's the job description. And the compensation structure that turns "move the stock price" into a job description is exactly where this series goes next. Who decided executive pay should work that way, when, and whether the alignment it promised ever actually showed up in the results. The mechanism is simple enough to fit in one sentence. Buy back fewer shares outstanding, and the numbers that matter to Wall Street go up, whether or not the business underneath them actually got any better. 42 years after a safe harbor rule that one dissenting commissioner warned would do exactly this, it's doing exactly this at a scale of nearly $1 trillion a year. The airlines showed what happens when the music stops and the cash isn't there. Most years, for most companies, the music doesn't stop, and nobody has to answer for the choice. Next time, the compensation structure that makes "move the stock price" a job description in the first place. Who built it, when, and whether the alignment it promised was ever real.